everyone. Thanks for joining and welcome back. Our guest today is David Busch. David is a chartered financial analyst who is a seasoned investment leader with a passion for transitioning complex market dynamics into actionable strategies. As co-chief investment officer at Trajan Wealth. How are you today, David?
I'm doing very well. Thank you for having me.
Yeah, thank you so much for coming down and speaking to the investment community, the silver and gold community here. First, I wanted to start off by getting your thoughts on what's happening in the precious metals market space. Then we can go into the broader market. But what do you think's happening right now in silver and gold?
Yeah, it's interesting because we've seen a pretty massive run up in the price of gold and silver over the last, well, I mean, year, but it's been trending this way for quite a long time. And I think that it's, obviously gold and silver and other precious metals are viewed as a store of value, especially when things are a little bit rocky, in the economy or the markets. But, that's my thought is that people are using that as a store of value. And that's why we've seen that run up in gold prices.
hmm Now, what about the broader market? I know that's what you specialize in, and that's what you focus on. Is there anything right now that you have your eye on, or is there anything that's concerning you in the broader market?
Yeah, that's a great question. So if we start on the economic side, the U.S., the Federal Reserve and their actions, as well as the government shutdown, and then we can go into the bond and the stock markets is if you'd like. But at a high level, I mean, the Fed cut rates 25 basis points back in September, which lower rates should provide a tailwind for growth companies. And historically, that's how it's been viewed, and we've seen that play out in the data. We now have, on October 1st, the U.S. government, entered into a shutdown phase because Congress failed to pass a budget. And so now the Fed is, data dependent, and Fed Chair Jerome Powell has stated that explicitly. But now we're seeing a delay in some of these economic releases, and so what we're seeing is a lot of headline risk or headline volatility in the
Right.
markets. On the fixed income side, where we're positioning is kind of in that 2 to 5 year part of the curve, because as the Fed continues to cut rates, the front end's going to come down more rapidly than call it the back end. And so this is a way for investors to sort of lock in yields. What I'm seeing is, and how this is playing out is, treasuries, U.S. agencies, and high quality investment grade corporate bonds are sort of the place to be. In investment or yeah, high grade corporates spreads are super tight right now.
hmm
And so if anybody wants to step out and look further out, or down the credit spectrum, I would just advise caution and a lot of due diligence. In the fixed income space, one of the areas that I'm most concerned with is the health of the US consumer. And what we're seeing play out in the data is rising delinquencies and defaults on things like credit cards, auto loans, specifically subprime auto. I mean, we saw what happened, earlier this quarter,
Right.
and so that's where I'm a little concerned. So I would say stay up in quality and manage that downside risk by not stepping out to grab yield or to chase yield.
Hello, my fellow silver and gold stackers. Please hit the like and subscribe button. It will really help the silver and gold community grow. It'll help this channel grow, and I'd really appreciate it. Back to the video. What
On
what do
the
you,
Go ahead.
No, sorry for cutting you off. I don't know if you've heard, but recently Morgan Stanley came out and for the longest time they for their clients and their advising and their perspective is 60% stocks, 40% bonds. Now the CEO of Morgan Stanley came out and said 60% stocks, 20% bonds, and 20% gold. What do you think is the reasoning for him to saying to his clients or to their massive amount of clients is, hey, time to sell bonds and go into something else?
Yeah, that's an interesting perspective. I haven't read that article,
hmm
so anything that I say would only be, my assumption here. But I think, as we've seen the price of gold increase and investors view that as a store of value, it could be, again, not having read the article, it could be having to do with that same phenomenon that I just described, which
Right.
is, credit quality may be deteriorating in certain sectors of the bond market. And if gold is considered a store of value, that would be the outlet for those investment dollars.
Absolutely. David, what else do you have your eye on right now? We've talked about bonds. It's a great, outlook that you gave us. But what else do you have your eye on right now?
Yeah, so in the equity markets, what's interesting is we've had a period of years that growth has outperformed value,
Right.
especially in the large cap space. I mean, when you think of all the large cap tech stocks and the names and how they've just grown rapidly, especially over the last 15 years, you know, what I'm advising or what I'm seeing is that, I still think, tech is the wave of the future. I still um, believe in, that AI is going to transcend or transform our economy in some very positive ways. However, what I would say to investors is, when it comes to large cap and large cap tech specifically, go up in quality, be mindful of the names, make sure that they have sound earnings, cash flows, and couple that with a value play. So think of dividend payers, value stocks, because that will help dampen some volatility that
Hmm.
we see in the equity markets, and it helps broaden out, an investor's exposure across equity sectors.
What would you say to people who are looking at this market or who's looking at the AI sector and saying that we're in a bubble in the AI space or even in the tech space?
I think that those concerns are valid. I mean, PE ratios are at a very high level, especially with those tech names and AI driven names. What I'm watching for there is there's a massive capex, capital expenditures that have to be put into place. I mean, think about the build out of data centers, power generation, um, getting supplies, like
Hmm.
semiconductors and so on. All of that is a massive spend, and so we have to look at that capex spend in conjunction with the monetization of that AI technology. And those companies that can monetize that AI technology and have that positive cash flow and earnings growth, those are the companies that are going to be successful. The others may fall by the wayside if their capital expenditures or if their earnings don't keep pace with those capital expenditures, especially over the near term, call it the next 2 to 3 years.
What would be your advice or your guidance, David, for anyone who is looking at large cap or who's looking at the equity space and saying, hey, I want to dabble a little bit more into that or I want to increase my positions? I know you said it to look at the higher quality stuff, but what would be your kind of your personal guidance for them?
Yeah, so go up in quality. So think about those companies that have strong balance sheets, positive free cash flows, positive earnings. Um, those that may have the ability to monetize that AI or that technology. And that's going to be a big factor moving forward. And so that's where I would look is and by strong balance sheet, not over levered, have a cash cushion, or a store of value somewhere on their balance sheet
Hmm.
that they can use to pay for all this capital expenditures that have to come in order to build this thing out.
What about interest rates right now? Do you have any idea whether like because I know a lot of people are calling for lower interest rates. The next move for the Fed is going to look at lower interest rates, but whether it's by 25 basis points or 50, how would that affect the sectors that you're looking at right now? And what do you think about the interest rates being lowered?
Yeah, so when the Fed cuts interest rates, they're only cutting the overnight rate. And so what happens is when you look at the yield curve, when the Federal Reserve moves and when they change interest rates, it's the front end of the curve that moves in a greater magnitude.
Hmm.
And so what we'll see, or what my base case is that we'll have a positively sloping curve. So if the Fed will cut, there's already two more cuts priced in between now and the end of the year. 2026 is a little more opaque. We don't know for sure what's going to happen because we got to let the data play out. But if the Fed cuts, two more times on the front end of the curve, that front end will come down. We'll have a positively sloping curve. So if we anchor right around that 5 year part of the curve, that's going to allow us to lock in yields, current yields, but also not be subjected to a ton of volatility. So what I'm pairing that with is on the front end is a modest allocation towards tips or real assets as
Hmm.
a hedge against a resurgence of inflation or persistent inflation. On the long end, the long end is going to be dominated by new treasury supply, as well as changing inflation expectations. So I would expect, call it 20 years and out to have a lot more volatility, especially headline risk, resurgence of inflation,
Hmm.
or new treasury supply. I think that's all going to play into that longer end of the curve. So for most investors, unless you're hedging something like an equity risk or you have a specific purpose for buying that far out the curve, then I would lean into call it that 5 year range.
There's about $15 trillion worth of physical gold in the world sitting there costing money rather than being used. It's just absolutely insane. Monetary Metals is bringing gold back into the financial world, putting gold to productive use right now. The problem with gold, of course, in physical form is that it's heavy, it's cumbersome, it's not particularly easy to ship, and it costs money to store in a protected manner. This platform Monetary Metals created is a proven concept and allows gold to be put to productive use. So instead of sitting there costing you money, it's actually in use earning you money.
Learn how you can earn 2 to 5% in our leasing program and how accredited investors can earn up to 12% on silver paid in silver. This advertisement is not investment or financial advice. Minimum investment applies.
What got you started into all of this? For people who don't know you, I know you've been on the channel before, but there's so many new people who have joined us in this investing channel and in this whole space and who's been following us. What motivated you to get in the space that you're in, and how did it all begin?
Yeah, well, thank you for asking that. I was actually in a college macroeconomics class.
Oh, cool.
I really didn't know, when I was in college, I was just kind of taking classes. I kind of had a vision that I wanted to be in some sort of business or finance major, but I took a macroeconomics class, and in this class, we had to pick a stock and we had to track it and graph it out and show, when to buy, when to sell, do the fundamental analysis. I still remember the stock that I picked was Walmart, and
Oh, no way.
this was in the late 90s. And so to get the stock price, I had to get the Wall Street Journal and every day go in and go to that section of the journal and find that price and plug it into Excel and so on. But during that class, that's when I first learned about the time value of money
Hmm.
and compounding interest. And it just, for whatever reason, it just really gripped me. And I thought, this is what I want to do professionally. And so that sort of started my career. And the funny thing is about my background is that I went to school and worked full time. And so
Hmm.
I worked, Monday through Friday from 7 a.m. to 4 p.m. at a brokerage firm, and then would take classes at night and on the
Wow.
weekends. And I took what I would consider probably one of the very first, online classes, because it was such a new technology in those days.
Uh-huh.
But that's really what drove me. And I eventually got my degree in accounting because I wanted to learn the language of business.
Hmm.
And I thought that that was a great framework for me.
Wow, that's incredible, David. I want to thank you so much for coming down to speaking to the whole investing community on this channel. I really want them to connect with you, though. I'm going to put your links in the description below. Where can they follow your work? Where can they follow you?
Yes. Trajanwealth.com, and follow us on all of our social media platforms.
Yeah, no, thank you so much, David. Huge pleasure. As the market develops, love to have you back on. It was a breath of fresh air having you come to speak, having you come speak to the whole investing community here. But as the market develops, really love to have you back on, David.
I would love to come back. Thank you.
Talk to you soon.